talking about mortgage, you'll probably hear the options of a 15-year or 30-year note. But what does that mean, and what is the advantage of one versus the other?
Steve Currington with CurringtonMortgage.com is here to explain the difference. Hello, sir.
.com.
Hello.
Good to see you.
Well, now, I'm trying to do the Dave Ramsey thing a little bit. And he says, just imagine there's a 15-year. Don't think of a 30-year loan. Don't even act like that exists. Is that a good way of looking at it?
Yeah, I think so. I mean, for some people, they need a certain size house and they can't afford the payment at a 15, so they do a 30. And really, the 30 is kind of the thing that everybody does. It's just I get a 30-year, that's what you do. But what we're seeing a lot of people do, especially when they're already in a house, with rates being as low as they are, is they can lower their current interest rate and their term. They can go from a 30-year to a 15, and their payment stays the same or goes down, or maybe it goes up a little bit. But what they're doing is they're reducing that term. So we had a guy I mentioned before we went on that was 4 years into a 30. His payment was $1,600 a month. He went to a 15, knocked 10 years off his loan, and his payment was $1,550. But the reason he can do that is because rates are so low. Because he started out on a 30 at say 6.5, and then he's getting a 15 at 3% less than that. So it makes a big difference. So really, you're allowing your money to work better for you. Some people, what they're doing is they get a lower interest rate so they can buy more house. Well, hey, I can afford that bigger house and do a 30-year because of that. And the 30 years is the safe play, okay?
Right.
Because you can, any of the mortgages we do don't have a prepayment penalty, so you can pay it off early, you can make additional principal payments.
Sure.
Then you're not locked into that higher payment, but you'd be surprised to see how little difference there is between a 30 and a 15 and the big scheme of things.
I was going to ask you, what is the big difference between money?
Without getting too technical, you're talking on a $150,000 house or a $100,000 house, $200 to $300 or $400 more a month than your payment. Okay.
Oh.
Wow.
But think about this: if you did a 30 and you paid $1,000 a month, you're paying it for 30 years. If you did a 15 and you pay and you do let's say it backwards. You do a 15, you're paying it 15 years at $1,400, and you're done. On a 30, you pay to that 15th year, and then you pay for 15 more years. Because you didn't pay for
that's double. Yeah, definitely.
It's I'm going to keep paying. So that's the difference.
One thing I've noticed, because I have a 30, and actually I've talked to you about maybe seeing if we could do the whole 15-year thing. One of the things that's high for me is my homeowner's insurance. And you suggested to me last time, you said, hey, you may want to check your insurance and just see.
Yeah.
I forget, because when I got my 30-year mortgage, which was the safe play, and it's all I really thought about, I don't pay more. I don't do a bubble payment or balloon payment, whatever it's called, and I forget to keep on it. Yeah. You can keep on it and really save a lot of money.
Yeah, and we watch it because I'm in the industry and I watch my insurance. Insurance guys probably hate me, and I have a couple that I do business with, so love you guys. But
sorry.
But we have a rental house that's with one insurance company. We have our primary residence that has another, and we have our cars with another insurance company. I see it every day, and I'm not gonna. And what happens is you move into your house, you get comfy, and in 13 months, they raise your premium by $120.
Yes.
You don't even really notice it.
Brent's is going up all the time. He's like,
you don't know why. My escrow, my insurance, I don't know what's going on.
So just shop it. That's what insurance is banking on you doing, is that you're just going to sign up and pay it for the rest of your life. So we have people that and it's not that they're just doing that maliciously. It's just premiums go up, and everybody's got a different scoring system. So yeah, that's another way that we've even told people before, you got no business refinancing. It's going to cost you $3,500. It's going to save you $43 a month. Your insurance is too high. Go get a better, go get cheaper, not cheaper coverage, but the same coverage for cheaper is what we're looking for.
I have to ask this. If there are people out there that are interested in knowing the rates are really, really amazing right now, and they're thinking, well, if I go to a 15, my monthly mortgage payment may go up just a touch, it could be really beneficial for the long run, right?
Right.
Even if things are going up.
And we can show them that. I mean, we can show you we call it widely known as a good faith estimate, but we call it the one we use for explanation purposes.
It's so much better than the bad faith estimate. That stinks.
I know. Well, the crazy thing about it is almost is a bad faith. There's no place to sign the new good faith estimate. That's kind of a funny joke. But the approximate loan cost illustration we can do without even pulling your credit. We can tell you what it'll save you or not, and help you make a good decision on whether you should refinance or you should go from a 30. Look, there's other terms that are available too. You can do a 20. You can do a 25-year. I just quoted a 10-year mortgage for a guy yesterday. And rates are low. So
really low. What are average right now? I know it changes like every day, right? Are you allowed
legally
to say?
We can't say, but I can say a range. And when you're in a 15-year, you're looking in the 3.5% range or lower on a 15-year. And when you get up to you're not going to see much of a change between that and a 10-year. You get it to 30, and you're going to jump up into the 4 range.
So basically what you're saying is right now is a good time to think about refinancing, maybe going to a 15-year if you can, and making sure that they give you a phone call to find out just more information if you guys are looking to maybe do that refinancing.
Yeah. It's a good, any lender should be able to give you a quote without having to worry about. A lot of them won't. They want to pull your credit. They go through all that stuff. But if you just need to run some basic numbers and have somebody that knows what they're doing, then that's what we can do for people and do every day.
Awesome.
Perfect. Thank you
great.
so much.
Thanks, guys.
Thank you.
All right, you can reach
CurringtonMortgage.com.
you can reach Steve at Currington Mortgage Company. Give him a phone call at 918-394-5626. You can also email him at steve@curringtonmortgage.com, or you can log on to
CurringtonMortgage.com.